Growth stocks aren't about hype. 3 ways to find real opportunities and avoid overpaying. Today, let's talk about growth stocks within value investing. Many people think growth investing is just chasing hot trends and speculative stories, but that's not what true growth investing is. At its core, value investing means profiting from a company's actual expansion, not overpaying for its growth narrative. So, let's break down how to identify real opportunities in growth stocks and avoid getting stuck overpaying. First, it's important to understand that growth stocks and traditional value stocks are not the same thing. Traditional value stocks are like that old noodle shop in your neighborhood. It's been around for 20 to 30 years, the taste is consistent, and it has a steady stream of regular customers. It doesn't make huge profits, but it's stable. Its moat often comes from cost advantages, low rent, established supply chains, and brand loyalty. The local regulars trust it. When you invest, you're mainly asking whether it's fairly priced today. You just don't want to overpay. Growth stocks, on the other hand, are more like a new bubble tea chain. It might not be profitable at first, but it's expanding rapidly, from 1 store to 100, with profits doubling along the way. As Peter Lynch wisely said, growth stocks aren't necessarily just tech companies. They're any business capable of consistently exceeding growth expectations. Their moat often comes from technological barriers, unique formulas, or network effects, where the more users they have, the more valuable they become. Think WeChat. Or it could be a chain with the ability to scale store count quickly. In short, traditional value stocks give you meat on the plate today. Growth stocks are about planting a tree now to pick fruit later. They're very different, but the core principle is the same. You still have to buy at a reasonable price. Don't pay a sky-high price today for fruit you might pick years from now. So how do we value growth stocks to avoid overpaying? We use a dynamic tool, the PEG ratio. PEG is the price-to-earnings ratio, PE, divided by the earnings growth rate. For example, if a company's PE is 30 and its expected annual earnings growth is 30%, its PEG is 1. Generally, a PEG less than or equal to 1 is considered reasonable. Above may first mean it's expensive, but PEG alone isn't enough. We need to refine it with 2 filters. Check the stability of ROE, return on equity. ROE tells you how profitably a company uses shareholders' equity. If a company is growing earnings at 30%, but its ROE is jumping around 20% one year, 5% the next, that signals unstable growth. Even with a PEG of 1, there might be hidden risks. It's like someone telling you, I'll earn $30,000 more each year, but last year they made $10,000, and this year they lost $5,000. Would you believe him? Examine cash flow quality. Earnings are an accounting number. Cash flow is real money. If a company's profits are growing 30%, but its operating cash flow is consistently negative, that means it isn't actually collecting the money it's earning. This kind of growth could be an illusion. Some companies boost sales by extending credit. Their profits look good on paper, but the cash is still in someone else's pocket. That's high risk. So here's the improved PEG method. First, find stocks with PEG less than or equal to 1. Then, make sure ROE is consistently strong, e.g., above 15% for 3 years straight. Finally, verify that operating cash flow is greater than or equal to net income. If a company meets all 3 criteria, you've likely found quality growth at a fair price. What kind of growth stock can become a 10-bagger? Peter Lynch identified a few key traits. Let's remember them. Leader in a niche market. It's not that the company is small, but that it dominates a specific segment with little competition. Think of a company that makes software for veterinary clinics. The total market isn't huge, but the whole industry relies on its system, making it hard for others to enter. When this kind of company expands, profits can multiply. Substantial management ownership. When the founders and executives hold a lot of stock, they're less likely to make reckless decisions with shareholders' money. They're more focused on building the business steadily. If you own 90% of your own shop, you'd care far more than if you own just 1%. Consistently improving profit margins. For example, if gross margin rises from 30% to 40%, it shows the company is gaining pricing power, able to charge more or lower costs. That's quality growth, not growth bought by losing money on every sale. A classic case, Amazon in its early days. In the 1990s, traditional value investors dismissed Amazon. It wasn't profitable, its PE was sky-high or negative. It looked overvalued by classic measures. Yet it became a giant. Why? Because traditional investors focused only on current earnings, while missing its long-term free cash flow growth. Amazon was spending heavily early on to build logistics and expand its product range. It seemed unprofitable, but its user base kept growing, customer loyalty strengthened, and its Prime ecosystem steadily increased its future cash flow potential. It turned out Amazon's growth wasn't just a story, it was future cash flow in the making. This teaches us that the value of a growth stock lies not in today's profits, but in its ability to generate future earnings, provided that future is visible and tangible. Growing users, a widening moat, not just a fantasy. Finally, a golden quote from Peter Lynch. If a company's growth rate can be sustained for 10 years, even a high valuation today might turn out to be cheap. The key is sustaining that growth for 10 years. Most companies can't maintain high growth for more than 3 years, so you need a sharp eye to tell what's real. Let's interact. Imagine a tech stock has PEG equals 1, PE equals 30, expected earnings growth equals 30%, but R&D spending is only 5% of revenue. Do you think it meets the standards of a true growth stock for value investors? Why or why not? Lightbulb asterisk. What drives growth in tech stocks? Technological iteration. Low R&D could mean weak future innovation, making it hard to maintain that 30% growth. Even with a PEG of 1, this growth might be short-lived. Would you buy it? Asterisk. To sum up, value investing in growth stocks isn't about ignoring price. It's about dynamically assessing whether the price matches the growth. The core principles are: growth must be backed by real cash flow. ROE should be stable. Price must be reasonable. PEG less than or equal to 1. The company should be reliable, a small leader in its niche, with committed management. Get these right, and you can make solid returns from growth stocks without paying for empty stories. Remember, a great growth stock is a friend of time, as long as you didn't pay a fortune for it up front. In the next video, we'll cover the turnaround investing strategy, how to spot quality companies the market has wrongly punished. If you found this helpful, feel free to like, share, and leave a comment. Your interaction means a lot. See you in the next one.